So leverage works in crypto that you have some Bitcoin and you want to borrow some more Bitcoin or some US dollars or whatever it is you want to do. So you will pledge your Bitcoin.
Before we move forward, I'd just like to remind you that we're giving away $100 to a random subscriber at the end of this month. To take part in it, all you have to do is subscribe to our channel, like this video, and leave a comment in the comments section below. Good luck. Now coming back to his interview, Raoul Pal talked about what we need to do right now in order to protect ourselves from the upcoming recession. He talked about how you can leverage your Bitcoin, what he thinks about Bitcoin's current cycle when compared to that of 10 years ago, and why the current Bitcoin cycle might be the biggest buying opportunity yet. He also suggested that we keep calm and hold on to our coins because he sees things getting better from here. If you want to hear Raoul's comments on the crypto market, watch this video till the end, and don't forget to press the like button. Now, let's look at his interview.
Leverage allows you to borrow future money to use now. So at two levels is humans are terrible. We just want everything now. We don't want to work for it. If I can borrow it and buy that Rolex watch or my new car, right? We're trying to meet our future expectations of ourselves always. That's what drives humans. So that's why they use leverage. And it's the same with investments. So they do it for purchasing power, to bring that future expectations of themselves. Have I earned enough money to buy that car? No, but if I borrow money, I can get my future self here. It's kind of a trade-off because you're actually in debt and you now owe somebody. You don't actually own the car. You own the ability to use the car until you pay that off. It's the same with a house, really. And the other point is for investments. You know, people love to borrow money now because then you can make a bigger investment now. But the trade-off is what happens if that goes wrong? Then before you know, you get a margin call or liquidated. And you know, that's a feature we see a lot in the crypto markets, for example. It happens kind of automatically. So humans just love this stuff because it brings their future expectations of themselves closer. I could be richer. I could have more stuff than I deserve now from my income. You can get in trouble if you can't pay your interest. So let's say the economy slows down and you lose your job. Now, what seemed like a reasonable payment suddenly becomes impossible. And then you get in arrears, and then you get the little tap on your shoulder, which is like, I'd like that house back now. Because you don't own that house. We, the bank, do. This is what people don't understand with leverage. You don't own that thing. You only own it when you pay it off. So that's what happens when you lose your job. You then can't afford to pay your mortgage payments. Now, there's a difference between the US and Europe for this. So the US, you give the keys back to the bank. It's not the end of the world. In Europe, the debt stays with you.
Oh, God.
Yeah, it's very different. So it is a
They get the house back and you still owe the debt?
Correct, because the house is valued less, particularly when what you get, what we refer to as negative equity. You buy a house for 300 grand and it's now worth 200 grand. You owe the bank 100 grand. Now, it's okay if you can still make the payments and eventually you just pay off the mortgage. But the moment you can't, they're like, well, you owe us 100 grand. And they take you to court and you carry that and you go to bankruptcy.
Oof.
And that's how housing is rare in the US. Most other leverage doesn't have the same process. Most of the leverage get the tap on the shoulder saying, I want my money back. And you end up going to court and you end up going bankrupt. So leverage works in crypto that you have some Bitcoin and you want to borrow some more Bitcoin or some US dollars or whatever it is you want to do. So you will pledge your Bitcoin and your interest payments
as collateral.
And your interest payments are whatever they are. But what happens is if the collateral falls and the exchange or whoever it is, or the DeFi protocol says, oh, it doesn't cover the amount, you get liquidated immediately. There's no negotiation, no, oh, please, no, nothing, just like boom, out, and you take the loss. Financial markets, like the futures markets, which is mainly for accredited or sophisticated investors, it's not an instant liquidation. And that's terrifying because suddenly something like the oil price, let's say you've bought some oil futures, what that is leverage on the future price of oil, much like you would do with Bitcoin. But oil sometimes can go down 10% a day, and because you've got leverage, before you know it, you're losing enormous sums of money. They don't liquidate you. They call you up and tell you owe them margin. And you can get yourself in a huge mess. So leverage is very scary. The nice way of playing leverage is options. Options is something definitely worth people learning about. And a lot of people learnt on Robinhood, because then you're only putting up what you can afford. If you say, I can afford to lose $1,000 on this bet, it's basically like the instant liquidation thing. And you can only lose the $1,000. But you don't lose your whole underlying position. You just lose the $1,000 you bet on the price of something going from here to there by whatever date. That's an options bet. So you can put $1,000 down, you can get $10,000 of exposure. And if the thing falls 20% overnight, you've lost your 1,000 plus another 1,000 like that. And it's open-ended. If it goes down again and you still haven't met your margin call, you've lost another 1,000. Before you know it, it's entirely wiped out. And that's the problem, because when you borrow 10 times, a 10% fall wipes out your initial margin, the bet you put. But in the options market, it doesn't, because that premium is all you put in. You can't lose any more. And it has a time. So let's say it's 3 months. So even if it falls below and is worth nothing, it's still in existence, and maybe it comes back again 3 months later, you're okay still. So it's just a different way of doing. Let's talk about it in financial market terms, or macro terms. I think there's 3 things you need to do here. 1, income. Income rules the world. Income pays your bills. Income can pay your mortgage. Income does everything. Without income, you got nothing. Income takes hard work. It's hard to get up the ladder, earn more income. Secondly, is you need to have optionality. You need to have things that can pay off. A startup or a hobby business on the side can give you optionality, because you can build a business, and a business has intrinsic value, plus it can increase your income. That will never happen if you work for a corporation. Yes, you can have a great career and do fine, but you'll never have that extra upside that you and I have had by building businesses. So that is another thing, is focus on your income, work hard, look for other opportunities that can leverage that income and opportunity set that you've got for you. And then thirdly is, if I've got this income, look for investment opportunities that can change my life. And that doesn't mean being a degenerate gambler. It's like, simply put, if there is a thesis, for example, in cryptocurrency that you and I share, that this is a long-term network adoption of this incredible technology that is exponential in nature and highly volatile, you should be looking at the moments of extreme weakness, the blood on the streets moment, to be buying more, not on leverage, but just putting your money into it. So if you'd have bought a house after the 2008 crisis, you'd have done very well. If you'd have bought it at the peak, you'll have done less well, right? So timing matters. And I looked at this to give you a specific example, just wrote a whole article about this, is I went back with a bit of honesty, thinking, I'm looking at my ETH price and I'm going, why didn't I sell it at 3,000? I should have just, I could have bought it back cheaper. And I know that that is a siren song that goes in your head, right? Mental torture. And I've been in this space since 2013. So I went back and looked at my entries and exits and what I did in the past. And what had happened if I just bought and hold? And what had happened if I bought and hold and added when it was this far oversold? It's very simple. So I figured out that if so what I did is I bought in 2013, $200 per Bitcoin. It went up to,
Whoa.
It went up to 1,000. Sorry, it went up to 1,000 in 6 weeks. I was like, oh my God. But I had a long-term thesis. I wrote the first kind of macro strategy paper about the valuation of Bitcoin. I thought this could be worth $1 million. And let's assume I'm an idiot by 90%. It's still worth 100 grand. So this is the best bet I've ever seen. So I held on, and then it fell 82%. And I'm like, wow. But I'd taken the bet and I put money in, was not levered, and I could afford to take the bet. So I just thought, I'm just going to forget about this and just see, because this is a longer term thing. And you don't normally make money that fast, and it doesn't normally fall this fast. So let's just see. And then I kind of forgot about it, 2014. And then 2015 starts going up again. And then by 2017, I'm now mentally scarred from an 82% drop, coulda, woulda, shoulda. I then see confusion in the market about either we're going to fork Bitcoin to two different chains. The price is 2,000. I'm now up tenfold. I'm a genius. My macro bet has paid off, sort of. I sell out. It goes up to 20,000 in 3 months later, and I don't mind. I don't mind because I've made 10 times my money. What I did was deviate from my thesis. My thesis was this was a 10-year bet. And I took the money off the table within 5. And then I went back, and then obviously I bought back in June, May, something like that, 2020, and had a good run and put more money into it than I had originally in my original bet. And I worked out that I had, as opposed to just holding my original bet, I used a theoretical number. So I think it was, if you put 10 grand into that first bet, it would have been worth 1.4 million.
Whoa.
By doing the right thing, buying reasonably low and selling reasonably high, and timing the market. That was a small fraction. It was, in fact, I think I made 20% of what I would have meant if I held on.
Whoa.
And then I went back and looked at, okay, well, what did I actually do? Because I massively increased my position in June. I still underperformed by 5x. And then I'm like, okay, what happens if I'd done the right thing? What I should have done, which was my framework, which was you buy it when it's on sale, when there's blood in the streets. So I went back and looked at the bottoms of the bear markets, assumed I'm an idiot and I can't catch the bottom of the bear market and miss it by 30%. And just put the same amount in each time that I started with. That 1.4 million would have been 30.
Whoa.
Sorry, not 30, sorry, 3.
I was going to say, good Lord.
Had I rolled my profits in, had I just doubled down each time or whatever, the numbers go exponentially larger. And that really stopped me in my tracks. It's like, here's me doing the right thing, buying when it's in a bull market, selling when it's in a too strong a bull market, buying when it's down a bit. And I still didn't do as well as just holding it. And if I just added to it, I would have done well. And my framework is, this is a long-term trend, right? We've got at least another decade in this, at least, probably 2 or 3 decades. But this part of it is going to continue to do very well. Sure, Bitcoin over time, as it gets more users, more adopted, it won't go up as much each cycle, but there'll be plenty of others and plenty of opportunities. So what we should be doing is using this, thinking of the money you've put in as your retirement money and writing it off. And then just adding, if you've got money in a bear market. Now, the problem is most of us don't in a recession. But a friend of mine taught me very early on, he said, Raoul, there's a key thing I've learned is he who has cash in a recession is king. So that's that combination of income and opportunity. You've got income, you've got some cash, and now everything's on fire sale prices. You're the king.